Good morning. My name is Malcolm Neekirk. Welcome to Fretton's sixth coffee break briefing of 2025. We didn't have one last month, as instead we had our annual conference at the Bewley Road Hotel in the New Forest. Many thanks to all who attended. It was a great day, and I've had some very positive feedback from many of the delegates, for which I thank you. I hope you'll come to our conference next year. It's likely to be in May or June 2026. I'll keep this morning's introduction brief. I will circulate a list of dates for your diary by email when I send you the notes from this morning's presentation. But I will just say a few words about the next couple of coffee break briefings. The next one in the series is scheduled for Monday, the 11th of August. I have a guest presenter for it, my employment law colleague, Chris Dobbs. If you came to our conference, you would have heard his excellent presentation on company directors as employees. On the 11th of August, he will pick up on the item that was published in Dear IP 168, which was issued in June. And that talks about the inquiries and the checks that the Insolvency Service say that IPs should make to validate claims that are made to the Redundancy Payment Service. So that's, I think, quite a timely and topical presentation that Chris will be making on Monday, the 11th of August. I'm also going to try and squeeze in an extra briefing. Let's call it an espresso briefing, either later this month in July or possibly in August. And that's because I want to talk about the Novalpina ruling that was handed down last month. This seems to have important implications for MVLs that might last for more than a year. You might have to convert some of your long-standing MVLs into CVLs, and you might have to ask some more questions at the outset when taking on an MVL. I'm being asked questions about that, the Novalpina ruling already by insolvency practitioners, so I would like to give a briefing about it before the next scheduled briefing in the series, which would otherwise be in early September. So that's the 11th of August. Chris Dobbs will be talking about the inquiries and checks that insolvency practitioners should be making to validate claims made to the Redundancy Payment Service, and another date yet to be fixed, either in July or next month in August, to talk about the Novalpina ruling and how that affects MVLs. Right, I think that's enough waffle. Let's run the presentation now. So, hello and welcome to this coffee break briefing, which is on the HMRC's frequently asked questions on tax in personal insolvency, and I've sub-headlined this one, I've read them, so you don't need to. Now, I went to the R3 Personal Insolvency Forum in Manchester towards the end of February this year. Really good forum, and very much recommended. One of the topics that was under discussion was tax in personal insolvency, particularly bankruptcy. And we were told that this document, which was published at the beginning of June, was under discussion, had been under discussion between people from R3, members of the insolvency profession, and insolvency practitioners for quite some period of time, quite a number of years. And as I say, this was published early in June. There are 36 questions that HMRC has given an answer to, and I'm going to try and run through all of those in the next half hour, just very briefly to give you some idea of what this document contains. So let's see if we can get this working. There we go. So first 10 questions, I'll dive into the first one, which is about notification of bankruptcy. HMRC will probably know that the debtor is bankrupt already. They may well have presented the petition themselves, but they will not necessarily know that you have been appointed as trustee. So do tell them. And the contact details for doing that are in Public Notice 756. Now, there's a number of references to other publications scattered through the frequently answered questions. I won't refer to all of them as I go through here. as I'm sure you'll actually be referring back to the original FAQs on any issues that come up. Second question is whether HMRC will issue a new unique tax reference number for the debtor when the bankruptcy is made. And the answer here is yes, that is what they will normally do. That's their usual practice. And that effectively then rules off the bankrupt's tax affairs so that after the date of the bankruptcy order, the bankrupt becomes a new taxable person and their previous affairs are, I suppose, closed off under the old original taxpayer reference number they had. Which leads to the next question, can you use that original UTR to pay dividends in the bankruptcy to HMRC? And the answer there is no, please don't do that. There is guidance published by HMRC on where you should send dividend payments and what information you should give when making them. That was updated in June 2021. Question 4. The usual practice is to declare all realisations at the end of the case, effectively to give a closing account to HMRC and calculate the tax and pay it at the end of the bankruptcy without necessarily delivering annual returns. The question is that okay? And HMRC is saying, for now, yes, but that's likely to change in the future. And that then leads into question 5 about making tax digital and whether that is going to be extended to deal with tax returns delivered by trustees in bankruptcy. And I think the answer there is yes, it will, but at some date to be confirmed in the future. Question 6, and I have to say this is somewhat complicated. I've tried to summarise what's in the document. Not sure I understand it fully myself, so if it doesn't make sense, that's probably the way I've summarised it, and I would suggest that you go back and look at the wording in question 6 on the document itself. And it's where there are appeals being made against tax assessments. Who does HMRC actually talk to about the debtor's tax affairs? And HMRC have added R3 have added their own footnote to this particular topic following HMRC's response. And R3 are emphasising in that it's not the job of the trustee in bankruptcy to manage the debtor's pre-bankruptcy tax affairs. It's still the debtor who is responsible for filing outstanding accounts and returns. The trustee in bankruptcy is not the debtor for these purposes and is not the debtor's tax accountant. And the functions of the trustee in bankruptcy are to administer the bankrupt estate primarily for the benefit of the creditors, not for the benefit of the debtor and not necessarily for the benefit of HMRC. So a trustee in bankruptcy may sort out the pre-bankruptcy tax, may try to do so. That's not going to be the normal situation. Trustee in bankruptcy may consider doing that if there is a benefit to creditors from doing so, and if it's commercially sensible in terms of there being funds in the case to pay for the cost of doing it, and the costs of doing it are proportionate to the benefit that the creditors will receive from it. Anyway, the specific questions that R3 asked HMRC to answer are these. In terms of the pre-bankruptcy position, HMRC can serve assessments on the debtor despite the bankruptcy, but the trustee in bankruptcy has got the right to appeal those assessments, but then it seems to be for the debtor to actually agree the debt with HMRC. And R3 asked HMRC for practical guidance on how that should actually work if it happens. They asked, should all parties be involved in any agreement? Because clearly both the trustee and the debtor may have an interest in this, and there should perhaps be an understanding that trustees and debtors should not disadvantage each other in any agreement that is reached on this. And in many cases, the debtor will not benefit at all from any negotiations with HMRC about what the pre-bankruptcy assessments should actually be. And so the question was, in a situation like that, will HMRC agree the position with the trustee in bankruptcy only? long, complicated answer from HMRC, which I'm trying to summarise here. And what HMRC said is that where there is an assessment that includes a debt that is a provable debt, HMRC will normally serve it on the bankrupt and will also copy in the trustee in bankruptcy. So you should know about the assessment that's been raised. When they know that a debtor is bankrupt, they will try to contact you as trustee as quickly as possible to help sort out the taxpayers' arrangements. And they say that it is only the trustee in bankruptcy who has the right of appeal for pre-bankruptcy tax periods and the final tax period which straddles the date of bankruptcy. So R3's question following on from that is, who actually agrees the debtor's tax after an appeal has been lodged? And HMRC said here that trustees in bankruptcy may ask for an independent review of the assessment, or, I think this is a typo, I think they can appeal to a tax tribunal. And where trustees in bankruptcy don't request, again, I think there's a typo here, I think it should be a review or an appeal, HMRC will treat that as accepting that the tax is due. But they do say that if a trustee in bankruptcy wants to give more information after an appeal is submitted, HMRC will take that into account and consider if it changes the decision or the assessment. How is it done in practice? HMRC can't give any more specific guidance. They say it depends upon the facts. They always carry out compliance checks, and they will normally copy in the trustee in bankruptcy in any correspondence about potential assessments or compliance checks for debts that might be included on their proof of debt. So I hope that's a useful answer. As I say, R3 have added their own notes to the end of it. Question 7, very short and simple. What is the tax rate on income in a bankruptcy? And it's 20% on all income, but 7.5% on dividend income. And that is the same in Wales and Scotland as it is in England. Question 8 was a question about whether the trustee in bankruptcy can use the full basic rate band in capital gains tax, and whether that tax rate is different in bankruptcy. And the answer is yes, trustee in bankruptcy can use the debtor's basic rate band, and it is the same tax rate as would apply without the bankruptcy. Further question here raised by R3 says, well, what about these cases where the debtor is not cooperating and the trustee simply does not know how much, if any, the debtor may already have used of their basic rate band? And HMRC here said, well, in a case like that, claim the full allowance, explain the situation, explain your lack of information, and HMRC will put you right if you've claimed more than your entitlement of the basic rate band, which I think is probably quite a helpful answer. Question here by R3 asking for a de minimis agreement and saying that if the amount of tax that is payable in the bankruptcy is, let's say, £500 or less, that's just going to be disproportionately expensive to calculate it and account to you. Can we just say, we'll just ignore it if it's less than that? And HMRC said, no, that would require a change to tax legislation. We can't agree a concession like that. Question about whether it's possible for a trustee in bankruptcy to use the debtor's personal tax allowances in calculating the income tax that the trustee in bankruptcy has to pay. And HMRC said, no, you can't do that. Trustee in bankruptcy is entitled to use the debtor's capital gains tax allowances because the debtor's capital assets are actually vested in the trustee in bankruptcy. But the debtor's income is not vested in the trustee in bankruptcy. Therefore, the debtor remains entitled to claim their allowances for income tax. Moving on to questions 11 to 20, and we move on to the topic of private residence relief in capital gains tax. And this is essentially the exemption when you sell your home. That means you don't normally pay capital gains tax when you sell your home, even if you make a profit on it. Question is, can the trustee in bankruptcy also claim private residence relief from capital gains tax when they sell the bankrupt's home? And the answer is yes, they can, but only if the debtor themselves would have qualified for it at the time of sale. So it's down to whether the debtor was using that as their home, not whether the trustee in bankruptcy was using it as their home. Supplemental question to that is, what happens if the debtor moves out? And there is a 9-month rule in this case, which is that the private residence relief continues to apply for 9 months after the property stops being your home. So the question is, does that 9-month rule apply? So if we evict the debtor and sell the house within 9 months after evicting them, can we still claim exemption from capital gains tax? And the answer to that is yes. And supplementary question there was, it's often hard to know whether the property was actually the debtor's own home. Can we assume it was in the absence of any better information? And HMRC said, well, yes, only if it's reasonable to do so. And HMRC would expect trustees in bankruptcy to use your statutory powers of investigation to uncover the facts. And that could be, of course, expensive and inconvenient to do that. But I think the issue here is that if there is any doubt at all about whether the property was the bankrupt's private residence, you ought to disclose the facts to HMRC. And if there are unknowns, you ought to explain what the unknowns are and why you don't know the answer to them. There were then further supplementary questions here, questions 32 and 33, and I think I'll flick across to those right now to deal with those because it seems to be the right place to do so. So there was a request here for HMRC to give guidance to trustees in bankruptcy about the evidence that would be accepted by HMRC when you're looking to claim private residence relief. And HMRC said, well, we've got guidance for the general public. We're not going to give any further advice to trustees in bankruptcy. And question 33 was saying, look, it can sometimes take a very long time to sell the debtor's former home once we've evicted them. Can we be allowed more than 9 months before we start to lose private residence relief? And HMRC said, no, that's 9 months. Everybody gets 9 months. No concessions on that. When a debtor is in prison, does that become their main home? In which case you would lose private residence relief. And HMRC said, well, maybe. Depends upon the circumstances. So, for example, look at how long they are actually away from home for in prison. Look at whether their family, their spouse, is still living there while they are away. Just look at all of the facts. So there's no clear answer to this, I'm afraid. You're just going to have to make a decision based on the facts. We move on now to refunds for payment protection insurance and interest rate hedging payments, and whether the tax on those should be paid as an expense of the bankruptcy or is treated as a pre-appointment unsecured claims. And the answer the HMRC have given here is to say that for interest rate hedging product refunds, then yes, usually it will be a part of their unsecured claim with a tax on that, assuming that the bank paid the refund either before the bankruptcy or in the year straddling the bankruptcy order. For payment protection insurance refunds, tax is normally deducted at source, so this shouldn't be an issue for the trustee in bankruptcy. There was a supplementary question. It's not actually question 35, it's question 34. And this is, what should you do if you are paid one of these refunds gross and you realise that it should have been paid net, that tax should have been deducted before it was paid to you? And HMRC are saying, give us a bit of time, we're thinking about that particular one. The rate of tax that applies to these refunds is the default basic rate of 20%. And now moving back to an issue is similar to one of the early questions, where the situation is that the debtor does remain responsible for their tax affairs despite the bankruptcy, and this means that the trustee in bankruptcy does not have the right to make claims or elections on their behalf, even though that might actually benefit the bankrupt estate to do so. The question was, can this change if that's inequitable? And HMRC have gone away and said, we need more time to think about that one. Question 17, I think this is a useful one. This is dealing with the capital gains tax and how you calculate the capital gains tax when you sell an asset. And the capital gains tax is, of course, calculated on the profit that's made, the capital gain, and you are entitled to deduct the costs of realizing the asset from that. So if it's a property that's being sold, you'd be able to take off the estate agent's fees and the solicitor's fees. The question was, are the trustee in bankruptcy's time costs for dealing with that sale a legitimate deductible expense when calculating the capital gains tax? And HMRC have said yes, they are, and they have amended their guidance to reflect this. And it is only that part of your fees that are directly attributable to the sale of that asset that you can deduct. You can't deduct general costs of the bankruptcy, and R3 recommend that you should clearly mark on the invoice the figure that is attributable specifically to the realization of this particular asset. Now we move on to the trustee in bankruptcy's responsibility to pay capital gains tax as a bankruptcy expense. And the example here of where a secure creditor has put receivers into investment properties owned by the bankrupt and they sell them. And the question is it still the trustee in bankruptcy's responsibility to pay the capital gains tax as an expense of the bankruptcy in a situation like that? And the answer is yes, it is. And it doesn't matter whether the receiver was appointed before the bankruptcy or after your appointment. It makes no difference. It is still your responsibility as trustee in bankruptcy personally to pay the capital gains tax and calculate it as a bankruptcy expense. And there's a reference there to question 36, which is actually question 35. And this is supplementary saying, well, what happens if the secured debt wipes out all of the realizations from the property? So no equity comes to the trustee in bankruptcy, and the trustee has no realizations from this property with which to pay the capital gains tax on it. And the answer is you still have a statutory duty under the insolvency rules to pay the capital gains tax as an expense of the bankruptcy from other funds available in the bankruptcy, and that will have priority over some of your own remuneration, potentially. Supplementary question here. Suppose that there is a property with no equity in it. Can the trustee in bankruptcy disclaim it so that the capital gains tax on its sale is not payable as an expense of the bankruptcy? And HMRC said, yep, that's legitimate. That's an appropriate use of the power to disclaim. And they say, well, in a situation like that, they may then look to the person who sold it to pay the capital gains tax. Well, I don't think it's going to be the receiver's responsibility to pay the capital gains tax. I doubt that it's going to be the responsibility of the mortgagee in possession either. In which case, it's likely that HMRC will simply add the unpaid capital gains tax to their unsecured claim in the bankruptcy. So I guess the takeaway from that particular point is, do use the power to disclaim if there are properties with negligible or no equity in the bankruptcy estate, because you might actually be simply causing expense for yourself in either selling them or even allowing somebody else to sell them. You might be better off disclaiming them. Still on the subject of capital gains tax, suppose the debtor has accumulated pre-bankruptcy losses. Can the trustee in bankruptcy use those and set those off against gains made, capital gains tax that would otherwise be paid as a bankruptcy expense? The answer is yes. If the trustee in bankruptcy can't use them, can the trustee in bankruptcy sell them back to the debtor so the debtor can use them in the future? And again, the answer to that is yes. This applies only to capital gains tax losses. Moving on to questions 21 to 30. Question 21 is about APNs and FNs, and these are tools that HMRC use when they're dealing with tax avoidance schemes. An APN is an accelerated payment notice. Suppose there is a tax avoidance scheme that is being disputed by the taxpayer and HMRC. In some circumstances, HMRC can say to the taxpayer that they want them to pay on account some or all of the disputed tax as a payment on account in advance while waiting for the final ruling on whether the scheme is good or not. So that's an accelerated payment notice. There may be cases where HMRC has won a victory in the courts and has had a similar tax avoidance scheme ruled as ineffective. In those cases, HMRC can, in some cases, serve a follower notice on the taxpayer, and that's essentially a warning to the taxpayer that if they carry on fighting with their scheme, which is similar to one which has been struck down in court, if they carry on fighting, HMRC are giving themselves the right to impose additional penalties on the taxpayer if they win in court themselves. And HMRC will often serve both follower notices and accelerated payment notices when dealing with the same tax avoidance scheme. So the question here is, suppose that HMRC have issued an advance payment notice, which is a demand from HMRC to the taxpayer to make an advance payment on account of potential tax that may be due. If the taxpayer doesn't pay that, is HMRC justified in presenting a bankruptcy petition? And HMRC said, not going to answer that. We deal with those cases on a case-by-case basis. There's a duty on trustees now to register their trust with HMRC, so HMRC is aware of the trusts that exist around the country. Question was, does the definition of trust include a trustee in bankruptcy? And HMRC said, no, it doesn't. You do not have to register as a trust when you are a trustee in bankruptcy. The next question is, what happens when the bankrupt dies during the course of the bankruptcy? First question is the capital gains tax now calculated on the market value of the assets at death, effectively resetting the capital gains tax to the benefit of the creditors in the estate? The answer is yes, that does happen. Is it the trustee in bankruptcy's responsibility to file the inheritance tax return if the bankrupt dies? The answer is no, you don't. And third one is, does the death of the bankrupt, effectively turn the bankruptcy estate into a trust, which now has to be registered with HMRC? And the answer again is no, it doesn't. No, you don't. Question about partnerships. We're not talking about Scottish partnerships here, which are different, of course. And the question is, do partnerships become opaque for tax purposes if a partner is bankrupt? HMRC's answer is no, they don't. Partnerships remain transparent for capital gains tax purposes, even if a partner becomes bankrupt. That's different from LLPs, which do become corporations and do pay tax, capital gains tax on gains if they are wound up. Question 25 is about individual voluntary arrangements, and the question here is just checking that it is the debtor and not the supervisor of the IVA who is responsible for post-IVA tax. And HMRC's answer is yes, that's right, for income tax, national insurance contributions, and VAT. In each case, the post-IVA tax is the responsibility of the debtor. And HMRC said, but that's different for capital gains tax, where it is the supervisor's responsibility for capital gains tax on the basis that assets may well be realised to pay dividends in the IVA. R3 say it's a bit more nuanced than that, and I agree with IVA about this. They say you should read the IVA terms, and most IVA proposals, and it will depend on the IVA proposals, most IVA proposals say that the supervisor is due to pay the capital gains tax that is payable on the realisation of assets within the IVA, as long as they have realised enough from the sale of that asset to pay the capital gains tax. Question 26 is just observing that in many IVAs, HMRC's vote can be the decisive one that turns it from a failed to an approved IVA. And so there was a question here about how nominees should make sure that HMRC have got proper notice of a proposed IVA. HMRC's answer is there is guidance online. It was published on the 11th of April this year. Follow that to notify HMRC of an IVA that's being proposed. Follow-on question from that is, will HMRC support an IVA only if they are forecast to receive 100 pence in the pound? And what is the best way to seek HMRC approval of the proposal? And again, HMRC has said just refer to our online guide of the 11th of April. And that's the answer that they gave to the third question about IVAs, which is if HMRC want a dividend of 100 pence before they will approve an IVA, is that going to also apply to additional liabilities? So if an avoidance scheme is challenged, which means there's additional tax to pay, and that brings the dividend down to less than 100 pence, does that mean the IVA should fail? And they say, again, look at our online guidance about that. Question 29 was about Scottish protected trust deeds and asking whether the tax treatment is the same as IVAs. HMRC said, no, it's not. So if you're dealing with a Scottish protected trust deed, as with everything else, don't just assume it's an IVA, but done in Scotland, it is something quite different and the tax is different too. Question 30 goes back to the beginning again and is asking if HMRC will tell the trustee in bankruptcy about any compliance checks that are open against the debtor and if any tax assessments are issued to the debtor. And HMRC has said they've updated their compliance handbook, so now, yes, they should be telling the trustee if they issue any tax assessments to the debtor. And we're moving on to the final 6 questions, 31 to 36, and I'll skip over the ones that I've already covered. So there's only 2 or 3 of these. Question 31 is what happens if both the trustee in bankruptcy and the debtor find themselves claiming the same capital gains tax allowance? And HMRC said, well, that shouldn't happen. As long as you're sharing information with the debtor, that shouldn't happen. And then they said, well, of course, we know that you don't always have all of the information. HMRC do expect you to make inquiries, but they will understand that you're not always going to be able to do that, and you're not always going to get answers to your inquiries. And they're saying that you should say on the return, if you don't know, if the debtor may have used some of the capital gains tax allowance, and explain why that is. And then they say they're unlikely to penalise you, which is nice of them, if they think you've acted competently in good faith and you've disclosed all relevant facts at the time. So I think the key thing there is if you do not know whether you are entitled to use the debtor's capital gains tax allowance, you should explain that to HMRC, say that you are claiming it, but here's the facts, and you just don't know whether you are entitled to use it or not. Final question, question 36 is what happens if you file self-assessment returns late? Is there any scope for leniency? And the answer is there are no concessions that apply specifically to trustees in bankruptcy. You've got the right to appeal any late filing penalty, and you need to give a reasonable excuse for filing it late if you're going to lodge an appeal. They're saying that penalties will be changing soon with effect from the 6th of April, and there are details of that on their website under the heading of penalties for late submission. So that's my quick run through of the 3 dozen frequently asked questions that HMRC have provided answers to, and particular thanks, of course, to the people at HMRC who have worked on getting this information out into the public domain, to the people at R3 who have been pushing at this for quite some considerable length of time, and particular thanks to the individuals named on this who have all been involved in getting these frequently asked questions issued. I don't think anybody's asked any questions. Oh, hang on, there may be a question there. I'm not sure I'm going to be able to answer any questions. And this is regarding question 23, and the question is, if the trustee doesn't have to file the inheritance tax return, who does file it? Well, the answer to that is it will be the executors of the estate who file the inheritance tax return. Now, there may well be nothing in the estate because it will all have vested in the trustee in bankruptcy, but technically speaking, it is for the executors of the estate to file the inheritance tax return. If there is a will, the executors may decide to renounce probate and not take office. If there is no will, then there could be administrators appointed under the rules of intestacy. And if it's an insolvent estate, then a creditor could seek to be appointed as administrator of the estate, or there could be an insolvent administration estate order made, which would effectively wind it up in bankruptcy with an insolvency practitioner appointed, and that insolvency practitioner would have to deal with it. But I think as far as you're concerned as the trustee of the bankrupt estate, this is the sort of problem that you can paint bright pink and put a large sign on it saying this is somebody else's problem. It is the executor of the estate who will be filing the inheritance tax return. So, Liz, thank you very much for asking a question that I could answer. There are so many that I would not have been able to answer on this subject. Before I go, I'm just going to say a few words about the next couple of coffee break briefings. Just repeat what I said at the outset for anybody who might have missed it. The next coffee break briefing is set for Monday, the 11th of August, and we have a guest presenter who is my employment law colleague, Chris Dobbs. If you came to the conference, you'll have heard his really good presentation on company directors as employees. I've asked him to pick up on the item that was published in the last Dear IP number 168 in June, which is about the inquiries and the checks that insolvency practitioners are being asked to make to validate claims that are being made to the redundancy payment service. So Chris will be talking about those, and I hope maybe coming up with some sort of a checklist as to what you should perhaps be recording yourself as having seen and looked at to comply with your obligations there. And I'm also going to try and squeeze in an extra briefing either later this month or in August. And that's because of the Novalpina ruling on MVLs that was handed down last month. And the essence of that ruling was to say that if the liquidator is unable to pay creditors within 12 months of the start of the MVL, then regardless of how balance sheet solvent the MVL is, it should be converted into a CVL. And I think that's got really quite important implications for any MVLs that you've got that may have been running for more than a year and have still got creditors outstanding, any MVLs that you've got that have been running for less than a year but might be in that situation, and indeed any MVLs that you're looking to start now or in the future. So I'm being asked questions about the Novalpina ruling already. So I want to cover that in an extra briefing. I'm going to call it an espresso briefing, either later this month or next month. So I'll circulate an email with the details of that in due course. So do stick the 11th of August down for the inquiries and the checks that IP should be making to validate claims to the redundancy payment service, because that's the scheduled coffee break briefing in August. And I say there'll be another one on the Novalpina ruling either in July or in August. Right, you've all been very patient. I've run out of things to say now. I can't see there are any more questions. So thank you all very much, and see you again online, either on the 11th of August or for the Novalpina ruling, or indeed for the September coffee break briefing. Thank you all, and goodbye.